Hi friends, welcome to Adda 24/7. We are in the SANKALP series for BFM and this is class 4. Today we will be covering module B of risk management. Objective questions. Kindly follow my yesterday's video for the summary series for the BFM. Kindly follow it. Okay. All the details of module A are covered in that. Some theory, some numericals, some objectives, everything. So follow it. And for today's video, remember risk management module B, very difficult part, the toughest part of your BFM and toughest part of your CAIIB. So follow this video till the end. Let's start. We'll directly hit the objective questions without wasting the time. Okay. So the first question is, now you'll have to answer it, everyone. Okay. The functions of derivatives are, means why are derivatives used? Firstly, what are derivatives? What do you mean by derivatives? Derivatives means they are derived. Remember this word, derived from something. Means it can be options, it can be forwards. Forward is also derivative. Forward. It can be future. It can be swap. It can be FRA. Forward rate agreement. Okay. Or many. It can go on and on and on. Anything which is derived from some commodity means what? These are like the tree and a creeper. Have you seen the tree and a creeper? We have this tree over here, right? This tree, and a creeper goes around this tree, right? It moves around. It does not have its own existence. Creeper means all that Karela, everywhere, all these, the whaley we call it, whale, creepers. So these stay on the tree. Similarly, these derivatives can function only when there is some commodity. They can't have their own existence. What do you mean by this? Suppose if I say derivative of Reliance or derivative of option of Reliance. So it means Reliance share should be existing. Option of Reliance. Reliance share we call it. Reliance means Reliance share. So option of Reliance means Reliance share must first exist. Okay. There should be existence of this Reliance share, only then the option can exist. So what is the function? Why are these derivatives used? It is useful in providing flexibility to the market products. It is an important tool for hedging market risk. Both A and B and none of these. So what is the answer? Yeah. See here, firstly remember flexibility to the market products. Because of these derivatives, what happens? There is a huge liquidity in the market. Otherwise, without this derivative product, the market will be too illiquid. Also, hedging the risk. Hedging the risk means what? Always, I'll give you one thumb rule. Suppose if you are long on any commodity, long on, let's say dollar. Okay, this is one commodity. Reliance share is one commodity. Dollar is another. Gold is another. Agri products is another. So that's why the commodity can be anything, and derivatives can be derived on any of these commodities. So whenever you are long on commodity, you'll always buy what? You'll always buy a put option to hedge the risk. Put options. Here in commodity you are long. Long means what? Buy now and sell later. Sell later. That is known as long. Okay, later. This is known as long on commodity. And put means what? Whenever the value of that commodity goes down, understand this. Whenever the value of the commodity goes down, at that time the put comes in action. The price of the put goes up. If commodity goes down, put will go up. Put price will go up. Okay. So that's why what happens? If I'm long on dollar, then why am I buying the dollar? I'm buying this dollar. Let's say let's look at this. Let's say dollar is right now at $1 equals to, let's say, 80 rupees. Okay, 80 rupees. Now, if I'm long on dollar, it means what? I'm buying this dollar right now. Whenever it goes up, okay, then I'll sell it, right? So I've right now paid 80 rupees for this dollar. So now if this dollar goes to 100 rupees, it means what? Now $1 is costing 100 rupees. So I'll immediately sell it. So this is known as long position, long. But the problem over here is, if this dollar goes from 80 to below, it goes from 80 to let's say 70, then I'm at loss. For that I use this derivative position. For that I use this put position. So the answer over here is both A and B. Got it, everyone? Important point to remember. What is the use of derivative? It is for hedging the risk. Hedging. Okay. The risk of loss from inadequate or failed. Okay. Inadequate or failed internal processes, people, systems is known as what type of risk? Now this is simple part. Every one of you must be able to answer this. Process, people, systems, inadequate failures due to the inadequate processes. All these become the part of what? Is it credit risk? Is it market risk? Is it operations? What do you say? It is legal, compliance, fraud and operational. So it is operational risk. Always remember. The resulting due to inadequate or failed internal processes, people, systems or from external events. This is known as operational risk. Okay. Clear? Simple. Which of the following is not an operational risk? Now this again you'll have to answer. I'll give you 10 seconds. Okay. Everyone. Try to answer this. Yes. Are you getting this? How many of you are getting this? Yes, it is correct. Many of you have typed this. Not an operation. Compliance, transaction, legal and counterparty. So which of them is the answer? Counterparty risk. Remember, counterparty risk is not an operational risk. Remaining all of the three are operational risk. Okay. But this is known as credit risk. This is a part of credit risk. Always remember this. Okay. So this is a part of credit risk. Got it? Clear? Move on. Next one. The risk related to non-performance of a trading partner due to counterparty's refusal or inability to perform is known as dash risk. Liquidity, operational, counterparty or none. Now, non-performance of the trading partner means the one whom I have dealt with. Means, let's say I am the seller. Okay. If I have sold the goods are given, then what does it mean? This buyer should give me the money, right? Should give me the money, dollars I'll call it, okay? Should give me the money, but if this guy doesn't pay, then what? And there is reverse condition also. Let's say I am the buyer. I have paid the advance, okay, for buying anything. But the seller does not sell the goods, does not give the goods, okay? So he is not giving it. So in any case, what is this known as? Some party is not able to perform. So that is known as counterparty risk. Always remember this, okay? Counterparty risk can be to the buyer as well as to the seller, depending on who has given the money first or who has given the goods first, okay? Risk of legal or regulatory sanction, financial loss or reputation loss that a bank may suffer as a result of its failure to comply with any or all of the applicable laws, regulations is called as dash risk. Transaction risk, compliance risk, credit risk, system risk. See here, basically full question you need not remember. Regulatory sanction, only this much is also enough. Legal or regulatory sanction means if you are working in India as a bank, okay, if you are a bank in India, okay, India means I'll call it Bharat now, right? Bharat. So if you are a bank in Bharat, then which of them, whose guidelines have you to follow? You have to follow the guidelines of RBI, right? But if you fail to follow these guidelines, there are many banks who have failed to follow. and they have been penalized for that. So this risk is known as what? This risk is known as compliance. Similarly, if you are a bank in USA, so you have to follow the guidelines of, they call it Federal Reserve, FED, Reserve, okay, Reserve, Federal Reserve, okay. So bank in USA, Federal Reserve, bank in India, RBI. Similarly, all the countries, okay. So you have to abide by the rules and regulations given by that central bank, okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. So, like it, share it, comment. If you have liked up till now, if you have understood the video, kindly comment yes in the comment section. Everyone, kindly comment yes. Okay. Everyone like this channel, because in Officers Adda 24/7 you get, firstly, what do you get? See here, firstly what do you get? One is free YouTube series. Right now what are you watching? You're watching the same free YouTube series, right? And second thing what you get? Either free YouTube series, number one, and the next one what you get is latest updates on JIB and CIB. Everything they are updated immediately. Whatever are the updates from IIBF, they are immediately updated. So subscribe to it, click on the bell icon. Okay. Risk arising from adverse business decisions, improper implementation of decisions, or lack of responsiveness to industry changes is called as what? Adverse business decisions means you don't take the decisions properly. For example, I'll give you. Suppose if you are working in the bank and your bank is not prepared right now for giving the UPI payments, then tell me, will you be in the business at the present age? Not at all. You will be out of business. Okay. And secondly, all the banks are now selling insurance. If your bank doesn't sell insurance, where will your TPP income come? So this is known as adverse business decisions. Improper implementation of decisions. If your decisions are not implemented properly. Lack of responsiveness to the industry means whatever are the changes in the industry happening, if you lack it in that, then what happens? Do you know, anyone remembers the company Nokia? Nokia phones, right? Everyone was, in 2005 to 2008, isn't it? Everyone was having the Nokia phone only. There was no other phone. But where is Nokia today? Gone. Why? Android came. Nokia said no Android. Gone. People don't, people are not that much loyal nowadays. They look at the facilities. Okay. Kodak company. Remember anyone? Kodak films. Kodak, we used to get the advertisements in the television. Kodak films. Where is Kodak? Gone. Right? Mobile cameras have shifted everything. So this is known as what risk? This is known as strategic risk. This is also known as business risk. Business. Okay, business risk. This is also business risk. So, getting it, everyone? Next one. The major types of business risk include all of the following except, now we want except means which is not the business risk. Product pricing, diversification, credit risk, and all of them. Let me get the answer from you. See here, product pricing, this is related to business. Firstly, think logically what the question is. Product pricing, this is related to business, pricing of the product. Diversification, this is also related to business. What is diversification? And what is product pricing? Okay, let me give you one example for each. Product pricing, let's say, okay. Where is the mobile this going now? Mobile tariffs going. Before Jio came in 2016, what happened? You used to get 1 GB for 1 month. In 1 month, you used to use 1 GB, right? Now, what is happening? 1.5 GB, 2 GB per day. So, product pricing also changed accordingly. Call rates were being charged earlier. Now, what is call rate? Call rates are free now. Right? You can do this internet calling, means through WhatsApp, isn't it? Diversification risk. When you diversify into it, when Reliance diversified into Jio, It was an oil company. It diversified into Geo, right? Reliance. How many companies does Reliance have now? If you name them, you will be in. Means we also don't know all the names. One is oil, second is Geo, then is retail, then other things. Many of them. We only know three of them main, right? Similarly, Adani Group, they have many companies. Wipro, many companies, isn't it? So, product pricing, diversification. What is credit risk? Credit risk is basically unable to perform, as we discussed earlier. Credit risk are of two types generally, remember, country and this counterparty. So, this credit risk is not the part of business risk. Okay, product risk is a part, then product pricing, diversification is a part, but credit risk is not the part of this business risk. What is the other name for business risk? Okay, let me get it from you. Just now I told you in this session only. The other name for business risk is, anyone? Business risk, this question, business risk. The other name for business risk is, correct, it is strategic risk. Strategic. Again, this can also be called as strategic risk. Unable to think long term, unable to follow the trend. This is all strategic. Okay. Credit risk is, what is credit risk? A risk that the firm's borrower will not make the promised payments. The risk that the firm will not be able to get credit from the lenders. Get credit from the lenders. Okay. Then a risk that the firm will not have sufficient funds to make payments to the employees. So sufficient funds. Risk due to changes in the output and the input prices. And this is first one is what? Will not make the promised payments. So this, which one is the credit risk then? A, B, C or D? Yes. What did I tell you just now? Credit risk means what? Credit risk is of two parts, right? Credit risk consists of two parts. What? One is country and second is counterparty, right? Second is counterparty. Counterparty, right? So credit and country and counterparty. So what is counterparty risk? Counterparty risk means the borrower will not make the promised payment. So this becomes a part of credit risk only. So credit risk can come in form of either country risk or counterparty risk. What is country risk? Sure, it's not a part of this question, but you must know what is country risk. Country risk means, suppose I'll tell you to invest in Afghanistan. Chal. We are opening a company to invest in Afghanistan. Invest, everyone amongst you, chalo, invest 1 lakh rupees. Will you invest in Afghanistan? No. Why? Because you know Taliban has taken it over. So this is known as country risk. When the regulations of that company don't allow, or that country, regulations of that country don't allow you to do something, that is basically the country risk. Okay. Similarly to country risk, we have another risk called as sovereign risk. Sovereign. This is other variant of this. Sovereign risk relates to states. States. Okay. States means states of various, in USA we have various states, right? United States of America. So they are separate. Here, understand the difference between USA and India. It is United States of America. The states are separate. But India, it's not United States of India. It's India only. That's the difference. Okay. India means Bharat, not I dot, IN dot, all that. Okay. Chalo. The risk of adverse variance of market, mark to market value, of change in market price of interest rate instruments, equities, is called as, here, adverse variance of mark to market value of the change in market prices of means mark to market. What is mark to market? Mark to market means, suppose if I am having, let's say, Reliance shares. Reliance, okay. Now the rate is 2500, let's say, imagine, it is 2500 rate rupees. And I am having, let's say, 100 shares. So what is my amount? 2500 into 100, right? This much is my amount locked in. So what is that amount? 25 and 4 zeros, right? So 2,50,000 is locked in. Now if this price goes down from 2500, it goes to 2400. So am I selling this share now? No, I'm keeping it with me. It's just a loss, notional loss it is called as notional loss. So notional loss means I'm not selling it, but due to the change in the market prices, I'm feeling that I'm having a loss of 100. Okay, so it will be what, 24 lakhs, 1 lakh. So that is known as notional loss, and this is known as mark to market. Mark to market is not that simple. Okay, Silicon Valley Bank, anyone remembers SVB? Just how many months back? 5-6 months back, this bank failed, gone. It was due to this notional loss and mark to market. Okay, it had taken the deposits of all the companies, deposits, okay, savings and current, and it invested in long-term bonds, 30-year bonds, 30-year bonds. So when these companies came to withdraw their deposits, these 30-year bonds won't be yielding it right now, won't be giving you the money immediately. They'll be giving you after 30 years. So that's why this bank didn't have any liquidity to pay to these depositors. That was the main mark to market value. And that's why all the companies' overall failure was affected. So the risk of the adverse variance of mark to market value of change in the market price of the interest rate instruments is called as price risk, market risk, translation risk, and both A and B. Price and market. Translation is totally different. See, the answer is D, both A and B. Okay. Firstly, let me give you the answer A and B. What is translation risk? Translation risk means, again, it's a notional risk, but it's a notional risk for converting the dollar to rupees. Dollar to rupees means, let's say I'm SBI, and SBI is having, let's say, a branch in New York also, right? Because SBI is having a branch in New York. Okay, so SBI is having branch in what? USA. And second, SBI is having branch, main branch is in India only, right? So who does the reporting part? So in SBI, India will do the main reporting to RBI. Every March 31st, we'll report it to RBI. So while reporting to RBI, this SBI will have to report the balance sheet of India. That is obviously. So that is in rupees. But this USA branch, that is also the part of SBI only. So this part will also be added in that report, right? But this part is in dollars because USA. So what will happen in this case? These dollars will be converted to rupees. So dollar to rupees, that is the conversion. So when I convert these dollars, if the rate of fluctuates, then that is a notional loss, and that is known as a translation risk. So the risk of adverse variance of mark to market value of change in market prices is known as, so price and market, both A and B. Okay. Which of them, what is not a forex risk? So forex risk means foreign exchange. What is forex? Foreign exchange. What is foreign exchange risk? Here, foreign exchange risk arises when you have conversion between two or more currencies. Keep it simple. Two or more currencies. Two means what? Either it's dollar, rupees, two currencies or more. It can be pounds also. It can be yen also, Japanese yen, right? It can be euro also. And two signs, no? Yeah. And it can be Australian dollars also, AUD. Australian dollars is written AUD. They don't have a sign anything. Okay. So what is not a forex risk? We want not. Remember this. Risk which may arise due to favorable exchange rate movement is called as forex risk. This occurs on account of the open position in spot or forward contracts. It is applicable to individual foreign currency and all of these. So what is the answer? I think all of these is the answer, isn't it? D. What do you think? D is the answer? All of these? Because here, this occurs due to open position in spot and forward rates. So that is true. Is it applicable to individual currency? Yes, it is. Okay. So the answer not is what? The not answer is this. Risk which may arise due to favorable exchange rate. So here, whenever you have favorable exchange rate, that is not a risk. Keep it simple. Suppose I am having $1, okay, at what 80. I brought it at 80. So 80 rupees I brought buy. And now this dollar goes to, let's say, 100. So is there a risk to me? I'll sell it, isn't it? It has gone to higher rate, so I'll sell it. But if imagine this 80 rupees goes to 50 rupees, then there is a risk. Then I can't even sell it, right? Because the rate has gone down. So this favorable movement, this is known as a favorable movement, right? Favorable. Because favorable means what? It's on my side. And this is what? This is unfavorable. Unfavorable, right? So this unfavorable movement over here, this is a risk. So we want not the Forex risk. So this risk which may arise due to favorable is not a Forex risk, isn't it? Everyone, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. So what are you waiting for? Just tell me one thing. Let me clarify one point. For clearing any JIB exam, CIB exam or any exam, what do you need? One is lectures. Second, books. Third, check your knowledge. Tests. All of them are over here. Lectures, online lectures are available. Books are available. Ebooks are available. Tests are available. So what do you need else? Nothing. Immediately subscribe to this channel. Download this. Okay, download to this channel and download this app immediately. Isn't it? When an asset maturing in 2 years, the liability risk will be basis risk, yield curve risk, gap risk, embedded option risk. Difficult one, isn't it? When an asset is maturing in 2 years, means what? I've given a loan. Asset means loan. Loan is given and it will be repaid after 2 years. 2 years. Now, what does it mean? My funds are gone out. Funds are out, right? Now, the liability risk. On what basis do I give the loan? Suppose if I give the loan for, let's say, 100 rupees. Okay? Rupees 100, I have given the loan. So, if I have given the loan for rupees 100, I must have rupees 100. Then only I can give. From where will I get this rupees 100? So, this rupees 100, I'll get it from the liability. Means deposits. So, these liability deposit holder will pay rupees 100 to me, right? And then this money I'll give it as a loan. Simple logic. But the problem over here is this will be repaid in 2 years. But what about this liability person? The one who has given me 100 rupees, tomorrow morning he can come to my branch, right? Tomorrow morning, can't he come to my branch? He or she. Can't he or she come to my branch that give me my money back? But this guy will be paying me after 2 years. So what do I give to him? This risk is known as what? This risk is known as basis, yield curve, gap or embedded option. Which is this risk? Where the person who is holding this deposit or even the loan. Sure, in loan the question is different. Right now the question is only for deposit. But the same embedded option risk, this answer is embedded option. The same embedded option risk can be there for the loan also. Right? So here in this case, this liability person who has given me rupees 100 as a deposit, he can come tomorrow morning to my branch. Kindly withdraw. Not even come to the branch. Nowadays not required to come anywhere, isn't it? Directly sit on the laptop or mobile app, tuck, done, withdrawal, isn't it? So there is a embedded option risk. Okay. Similarly, embedded option risk can arise in case of loans also. Now it's not related to this question, but loans. If there is a good customer of your branch who is having, he is repaying regularly, and many good customers are there in any bank, isn't it? Roughly 99% of the customers are good standard loans. So imagine if the standard loan customers come for the repayment. Tomorrow if I say I am a good customer of your branch, I come to your branch tomorrow morning and say take this all 1 crore loan which I am having. This is my 1 crore. I have got the money, repaying it. So that is also embedded option risk for the bank, because Bank is losing on the income, isn't it? So both of them are the embedded option risk. So here, remember this option, embedded option is a ability of the loan borrower or the depositor to repay it back anytime. Okay. Funding liquidity risk is defined as what? Funding liquidity. Remember, liquidity basically excess of liabilities over assets, excess of long-term liabilities over long-term assets, excess of short-term liabilities over short-term assets, inability to obtain funds to meet the cash flow obligations, and all of them. What is the answer? So here there are 5 options. E is also given over here. So liquidity risk means what? What is liquidity risk? I don't have money to pay, isn't it? When will I don't have money to pay? If my expenses are more than my income. Simple. Expenses. If they are more than my income, then what will happen? I'll have a liquidity risk. If you are earning a salary of, let's say, 50,000, and tomorrow if your expenses per month are around 70,000-80,000, every month 70,000-80,000, what will happen? 20,000, this gap will always be a liquidity gap. So where will you fill this liquidity gap? From loans. Then there's a problem starts. The loan goes on and on and on. Okay. Same thing happens with the organizations also. Same everywhere. If your expenses are more, how can your expenses be more in a bank? If you have more deposits, here deposits, huge deposits, and your income means loans. Loans are lesser or loans are NPA. So in that case, what happens? Deposits are more, liabilities are more. This is liability more than the assets, right? If my liabilities are more than my assets, then I won't be having money to repay. So liabilities or assets, correct. Long-term liabilities or long-term assets, that is also correct. Short-term liabilities or short-term assets, that is also correct. Excess. Remember this word excess. And next one, inability to obtain funds to meet the cash flow obligations means whenever I require the cash flow, I require to pay to my depositor, but I am not having the money. So that is also correct. So the answer is all, isn't it? Liquidity risk means any type of risk where I won't be able to, and this D1 is the actual definition of liquidity risk. Inability to obtain funds to meet the cash flow obligations. But A, B and C lead to this D. Because of A, B and C, we face this D option. Okay. So that's why all of them are correct. Okay. Liquidity risk in banks manifests in different dimensions. Which are these? Dimension, what do you mean by this word manifest? All difficult words are used, isn't it? Manifest means simple, comes in different dimensions. Different dimensions mean different forms, different ways. What are the different ways? So, funding risk arises from need to replace the net outflow withdrawals, non-renewal of deposits. So, I'm facing a funding risk. So we are focusing on liquidity risk. Huh? So liquidity risk means funding risk is a part of liquidity. The time risk arises from need to compensate for non-receipt of funds. So that is also a point. Compensate non-receipt of funds means if my loans become NPA, then what happens here? As the same logic goes everywhere, assets and liabilities in any bank. Bank's balance sheet is of assets and liabilities. So if my assets become NPA, right, loans become NPA, this interest will not be received, but these guys have to pay the interest. So here I'll face the liquidity risk. So time risk from the need to compensate for non-receipt of funds, that is also true. So A is true, B is true. What about C? Call risk arises due to crystallization of non-contingent liabilities. Now what do you mean by this? All these things, okay? Many of us don't know this, right? Crystallization arises due to what? Call risk arises due to crystallization of contingent liability. So here A and B are true. Okay. Now I'm thinking of only of C, right? Crystallization. What is crystallization? Okay, you are a bank. Okay, bank. And what happens? You have a contractor, customer. contractor, okay? Contractor, who is your customer? Road contractor, okay? That road contractor gets a contract from the state government or central government, anyone, no? State, central, anything, or any government you call it, okay? Government. So what happens? This government wants this contractor to submit a bank guarantee. Only then they'll issue this contract to this person. So what do? You give a guarantee, dotted line. Guarantee. You give a guarantee to this government on behalf of your customer, contractor. Now what happens? This contractor does not build the road. Does not build. Perform, I'll call it. Does not perform. Okay, does not build means does not perform, isn't it? So in that case, what will this government do? Government will immediately come to you and show you that guarantee paper which you had given, isn't it? They'll tell you, see this guarantee paper you had given, this guy has not performed, now pay me. This pay me is known as crystallization. Whenever the notional guarantee or contingent liability comes on your head for payment, that is known as call risk. So, will this cause a liquidity risk? Obviously, urgent payment needs to be made, right? So, in this case, it's again correct. So, the correct answer is D, A, B, and C, isn't it? The features of the basis risk are, what are the features of basis risk? What is this basis risk firstly? What is this basis risk? Okay, let us read. Okay, the explanation is given in these options only. Let's see. When the interest rates of different assets, liabilities, and off-balance sheet items change in different magnitudes, it is called basis risk. Different magnitudes means what? Suppose if, let's say, I'll give you a simple example. Loan, asset, I'll call it asset. Sure, we always have to speak in terms of assets and liabilities now in BFM. We don't call them loans and deposits. Okay, so assets. Now let's say the asset rate of interest is 9%, and liability rate of interest, obviously it will be lesser. So let's say it is 7%. So what is my NIM over here? 2%. 2% is my NII, not NIM. NIM is the average of NII. Okay, means that is separate. So yeah, NII. So that's why this is called as NII, net interest income. Okay, so my NII over here is 2%. Now what happens? The rate of interest now changes for both. This asset or loan rate of interest falls to 8%, or let's say falls to 6%, 2% change. And this liability rate of interest, that falls by only 1%. And this is 3%. So this has changed by 3%. And this liability due to competition, this rate has fallen by only 1%, that is 6%. So my deposit rates are 6%, my asset rates are 6%. What is my NIM? 0. What am I earning? 0. So this is known as basis risk. When the liability changes by 1% and asset changes by 3%. So that is known as different magnitudes. So that is the answer. A is correct. What about B? And this also gives you the definition of basis risk. When the rate of interest of assets and liabilities change in different magnitudes, that's called as basis risk. When the interest rate of the assets arise in different magnitudes as compared to the interest rates of the corresponding liability, which may result in net variation in NII, net interest income, it is called as basis risk. Same, isn't it? So rate of interest for a liability changes in different magnitude as that of the asset. Basis risk is quite visible in volatile interest rate scenario. Volatile, what do you mean by volatile? Volatile means fast changing, fast, hugely changing. That is called as volatile. So that is also true. Because when the interest rates change heavily, many of the banks failed. Have you seen USA? The inflation rate in USA was 9.5% in December. At that time, the Federal Reserve started increasing the rate of interest. At that time, this interest rate had become hugely volatile. So how many banks failed? Many of the banks, SVB, then that second bank, Credit Suisse, okay, all because of that rise in interest. If USA would have risen their interest rate more, more banks would have failed. Okay, so answer is D, all of these. Okay. The features of the embedded option risk are, see here, embedded option risk, just now we did it. Embedded means what? Anytime that customer can come and close his loan or deposit. So let's come back to this option. When the bank is exposed to the risk due to the prepayment of the loan or premature withdrawal of the term deposit, it is called as embedded option risk. Obviously, isn't it? Premature withdrawal, prepayment of loan. Correct. This can be experienced in volatile situations. Also true. Why? Because if the interest rate changes heavily, then persons will immediately come to close their loans. If today my rate of interest for loans is, let's say, 7%, next month it becomes, let's say, 9%. Immediately what will happen? Good customers, standard accounts, they'll face the crunch of 2%. They'll immediately come and close this loan. So that is known as embedded option. This can be experienced in volatile situations. The greater the magnitude of the change in interest rate, the higher will be the embedded option risk, isn't it? Change in interest rate, if it is higher, then more chances are that the loans get closed earlier. Okay. So the answer is all of these. Okay. The balance sheet risk may result in, what is this balance sheet risk? Balance sheet, what is balance sheet basically? See, balance sheet is nothing but the match between assets and liabilities, right? So what is the balance sheet risk? When they don't match, means the interest which I earn, assets will earn me interest, right? And this will expense. This is known as expense. So this will expend. So if my expenses are more and assets are less, then there will be a mismatch. So balance sheet risk may result in what? Interest rate mismatch, obviously. Liquidity risk, obviously earning is less, expense is more, liquidity will be a problem. Forex risk, again that will be the scene. Forex risk, why? Because if my expenses are more, I am facing the liquidity crunch, I'll have to buy the funds. I need to buy these funds from either the local market or even the Forex market. So even the Forex market knows that I am having the liquidity crunch. So even that market will give me at a higher rate. So that's why Forex risk will be there. So the answer is D, all of these. Isn't it? Which of the following is not a transaction risk? Not. Okay, not. We want not now. Look at this. Okay. Mismatch in assets and liabilities. Credit risk. Price risk. Instrument risk. Not a transaction risk. Not. Okay. Mismatch in assets and liabilities. Credit risk. So transaction means what? Anything related to transaction. Price risk and instrument risk. What do you say should be the risk over here? I'll give you the option answer. Okay, I'll give you two options. So let me remove the incorrect ones. This and this. We want not the transaction risk. So these are all, okay, I'll give you the answer only. These are all transaction risks. These are all the transaction risks. Only this is not the transaction risk. Mismatch in assets and liabilities. That is the part of liquidity risk. So that's why this is not a part of transaction risk. Okay. Got it, everyone? So now, everyone, let me show you the batches here. The batches, join the batches immediately. Why? Because look at this. Let me come to the batches directly. Okay. See this. SANKALP batch 3, join immediately. Why? Because all the 4 subjects are covered. Numericals, objective questions, case studies, everything is covered. Mahapack, join this Mahapack. In Mahapack, you are getting live classes, video courses, e-books, tests, Maha and mini marathons, practice papers, doubt sessions, everything you are getting. So join this Mahapack immediately. Plus, you are getting huge discounts. What are the discounts? Okay, let me show you. Let's go to Adda 24/7. Okay, hold on. If you're having the app, I would always suggest you to go through the app. In the app, you're getting 1% extra. Okay, using the coin system. Coins means, see here, What is coin systems here? Once you go on purchasing on Adda 24/7, your credits get accumulated and those get converted into coins. Okay, so go to Adda 24/7 now. On Adda 24/7, say this. Click on JIB and CIB. Now you'll see this JIB, CIB, वहाँ पे October, JIB October, CIB November. Click on CIB November. You'll see the batches. Join this batch. See the SANKALP batch English. Join immediately. Just now started. Okay. Important part is recorded videos are available. So if you missed out on any class, you can definitely get back using the recorded sessions. Interactive classes, you can ask the questions there and then itself. Doubt clearing sessions are there. So you can ask the doubts. Click on buy now. Look at this. 80% off is already applied to you. JC80 code is already applied. 80% off. 23,999 reduces to 4,799. Huge discount, isn't it? So immediately join it. Also, I would suggest you should join this Mahapack. In Mahapack, you are getting multiple batches. Multiple batches. Okay. See the JIB, CIB Mahapack. Click on the CIB Mahapack. You get multiple batches and right now you are getting double validity using this code JC80. So multiple batches for all multiple batches means what? 8 to 10 batches per subject. So that many times you get the revision also. You get ebooks over here, tests over here, everything. You get electives over here. So click on buy now. See this, click on buy now. Done. See this, 51,572 reduces to 10,314. So 80% off and 12 plus 12 months. Double validity. Isn't it? Isn't it a golden chance for you? And remember, once you clear CIB, in how many months will you recover this 10,314? Hardly 10-11 months. Isn't it? So join it immediately. I'll be back tomorrow with another series. Till then, bye. Keep studying and do join the batches ASAP.